Most people believe that the stock market is only for experts with fancy suits, fast computers, and insider access. They think that big profits come from big institutions or professional traders who move billions every day. Joel Greenblatt begins this book by breaking that myth. He reveals a secret that sounds simple but changes everything. Ordinary investors can beat Wall Street if they know where to look and how to think. Greenblatt calls this the art of being a stock market genius, but not in the way people imagine. You do not need a genius-level IQ or a high-speed trading system. What you need is focus, patience, and a willingness to look where others are not looking. Most investors chase popular stocks or follow market trends. But Greenblatt says that real opportunities often hide in corners of the market that are too small, too messy, or too boring for big institutions to care about. He starts by explaining how the market often misprices special situations. These are events that temporarily confuse or scare investors, such as company spin-offs, mergers, bankruptcies, or restructurings. During these times, many investors act emotionally, selling or buying too quickly. This creates a window where the price of a stock does not reflect its true value. If you can stay calm, do your research, and understand the story behind the event, you can profit from that gap. Greenblatt compares this to shopping at a clearance sale. The best deals are not displayed in bright lights. They are hidden on the bottom shelf or behind the big brands. You must know what you are looking for. The stock market works in the same way. While most people are distracted by headlines or short-term news, you can find undervalued gems by studying special situations. The introduction also highlights another key idea. The stock market rewards those who think independently. If you are willing to ignore the noise, dig into company filings, and understand the logic behind a business move, you can uncover opportunities that even professionals miss. Greenblatt insists that this is not gambling. It is intelligent investing guided by logic, facts, and patience. He reminds readers that great investors, from Warren Buffett to Charlie Munger, built fortunes by thinking differently. They did not follow the crowd. They searched for value when everyone else was afraid. Greenblatt wants every reader to develop that same mindset. The goal is not to predict the market, but to identify specific situations where the odds are in your favor. The introduction ends with a promise. If you truly study this book and apply its lessons, you can learn to find investment opportunities that most investors overlook. You will learn about real cases where companies went through dramatic changes and how those changes created hidden value. Greenblatt will guide you through the steps of discovering and analyzing these opportunities, showing you exactly how and why they work. He divides the book into two main parts. The first part reveals where to look for profits. This section takes you deep into the world of special situations: spin-offs, mergers, restructurings, rights offerings, recapitalizations, and bankruptcies. Each of these events creates temporary confusion in the market, and that confusion can become your opportunity. The second part teaches how and when to invest. Here, you will learn the principles that turn knowledge into action. You will understand how to calculate risk, how to use patience to your advantage, and how to build a system that protects your capital while maximizing your returns. So before you step into the first part, Greenblatt asks you to remember this one truth. You do not have to be smarter than everyone else. You just have to look in places where others are not looking. Once you learn to recognize these hidden opportunities, you will begin to see the market differently. You will stop reacting to news and start acting with intention. Part 1. Where to look for stock market profits. Most investors spend their entire lives searching for the perfect formula. They read reports, follow financial news, and try to predict where the market will go next. But Joel Greenblatt shows that the real profits do not come from predicting the future. They come from recognizing special situations that temporarily distort prices. These moments appear when companies go through changes that most investors either misunderstand or ignore. Part 1 opens the door to this world of hidden opportunities. It is about learning where to look. Greenblatt explains that the stock market is not always efficient. Prices do not always reflect the true value of a company. In fact, emotions, confusion, and institutional restrictions often cause stocks to be mispriced. When big investors avoid small, complicated, or unusual situations, those opportunities become available for smart individual investors. He introduces the idea that every great investment begins with a moment of change. When a company spins off a division, merges with another firm, goes bankrupt, or restructures its debt, something new is created. This period of transition often causes investors to sell without thinking. Mutual funds and large institutions may sell shares simply because the new company is too small or does not fit their investment rules. That panic and indifference create bargains for those who are paying attention. Greenblatt calls these moments market orphans. They are investments that nobody wants. But hidden inside these neglected areas are companies that can grow, recover, or unlock value quickly once the chaos settles. He encourages readers to stop following the crowd and instead explore the quiet corners of the market. This is where ordinary investors can outperform professionals. The secret is to understand why these opportunities exist. They are not random. They appear again and again because human behavior never changes. People overreact to fear and uncertainty. Institutions prefer simplicity and size. And most investors hate doing detailed work. But if you are willing to study financial reports, look deeper into a company's structure, and ask the right questions, you can find treasures where others see trash. Part 1 is your map. Each chapter that follows reveals one of these overlooked areas. You will learn how to identify them, analyze them, and know when to act. Greenblatt does not just describe theories. He gives examples, real cases, and practical logic that can guide your thinking. He reminds you that this is not about chasing trends or guessing short-term moves. It is about understanding cause and effect. When something unusual happens in a company's structure, it often creates temporary mispricing. Your job is to recognize when that mispricing offers a safe and profitable opportunity. Before moving forward, Greenblatt gives one final piece of advice. Always think independently. Never buy a stock because it is popular. Buy it because you understand the situation better than most. If you stay patient and logical, the market will eventually correct itself, and you will be rewarded. Now the journey begins with the first, and perhaps the most common of these special situations. Spin-offs. When a company decides to separate one of its divisions into a new, independent business, the market often reacts with confusion and neglect. But within that confusion lies the potential for extraordinary profits. Let us explore how and why these spin-offs can turn ordinary investors into true stock market geniuses. Chapter 1. Spin-offs. A spin-off happens when a large company separates one of its divisions and turns it into an independent public company. Shareholders of the parent company usually receive shares of the new company automatically. On the surface, it might seem like nothing special. But Joel Greenblatt explains that spin-offs are one of the most reliable ways to find undervalued stocks. The key reason is simple. After a spin-off, many investors sell the new shares immediately without thinking. Large institutions and mutual funds often cannot hold these new stocks because of size limits, industry focus, or internal rules. For example, a huge fund that invests only in large-cap companies might receive shares of a small, newly spun-off company. Since it does not fit their investment category, they sell it right away. That flood of selling pressure pushes the price down, even if the business itself is healthy or full of potential. This is where opportunity hides. Greenblatt teaches that investors who do their homework can step in while others are selling blindly. The short-term drop in price often has nothing to do with the company's actual value. It is simply the result of forced selling and confusion. Once the dust settles, the stock often rebounds sharply as the market begins to see its true potential. But not every spin-off is worth buying. Greenblatt warns that you must look deeper to separate gold from garbage. The secret lies in understanding why the company was spun off. Sometimes, management wants to separate a high-growth division that was being held back by the larger parent. Other times, the parent wants to get rid of a struggling or controversial business to clean up its image. By reading company filings and press releases, investors can often spot the difference. Another powerful clue is management incentive. If the managers of the new company receive a large portion of their compensation in stock or stock options, it means their success is directly tied to shareholders' success. They have a reason to work harder and grow the business. When management has skin in the game, the chances of success increase dramatically. Greenblatt also emphasizes that spin-offs often reveal hidden value. A division that was buried inside a large company might not have received proper attention or resources. As an independent business, it can focus on its strengths, make faster decisions, and attract investors who truly understand its market. Many legendary investors, including Warren Buffett, have made fortunes spotting such situations early. He gives several examples where small spin-offs later grew into billion-dollar companies once they were free to operate independently. In most of these cases, investors who bought the new stock during the initial period of forced selling earned returns far higher than the market average. However, Greenblatt also reminds readers to stay patient. It may take months before the market recognizes the value of a spin-off. The early period after separation is often full of uncertainty, but that is precisely when the best bargains appear. Investors who rush to sell miss the opportunity, while those who understand the story behind the numbers profit quietly. The core lesson of this chapter is that spin-offs create temporary inefficiency in the market. While big institutions sell for non-economic reasons, individual investors can act logically. By studying management motives, financial structure, and long-term prospects, you can find gems hiding in plain sight. Spin-offs are just one of the many special situations that create wealth for those who know where to look. In the next chapter, Greenblatt explores another fertile ground for opportunity: mergers and restructurings. These events also cause confusion, emotional reactions, and temporary mispricing, which smart investors can turn into long-term gains. Chapter 2. Mergers and restructurings. Mergers and restructurings are situations where companies combine, reorganize, or change their structure in some significant way. At first glance, these events may seem complex and risky. Many investors avoid them because they do not fully understand the implications. Joel Greenblatt, however, shows that this complexity is exactly what creates opportunity. A merger occurs when two companies combine their businesses into a single entity. Sometimes, the acquiring company buys the target with cash, stock, or a combination of both. Restructurings, on the other hand, happen when a company changes its financial or operational structure to improve performance. This could involve selling divisions, cutting costs, refinancing debt, or reorganizing management. Both the situations create temporary confusion in the market, and that is where profits can be found. Greenblatt explains that during mergers and restructurings, many investors make decisions based on emotion rather than logic. They fear change, misunderstand the deal, or panic when stock prices fluctuate. Large institutions often have rules against buying certain stocks or holding specific combinations of securities, which forces them to sell during the transition. This creates a temporary gap between price and value, which a patient and knowledgeable investor can exploit. One of the key strategies Greenblatt emphasizes is risk arbitrage. This involves analyzing mergers to determine whether the stock of a company being acquired is priced correctly relative to the acquisition terms. For example, if a company announces that it will be bought at a certain price per share, the market may not immediately reflect that value. By calculating the probability of the deal going through and the likely payout, investors can make informed bets with a clear understanding of potential gains and losses. Restructurings often present even greater hidden value. When a company decides to sell assets, spin off divisions, or change its capital structure, it is often undervalued because investors focus on short-term disruption rather than long-term potential. Greenblatt stresses the importance of studying company filings, understanding the rationale behind management's decisions, and evaluating whether the market is overreacting. Often, the company emerging from restructuring is stronger, leaner, and more profitable than before. Another factor to consider is the behavior of insiders. Executives and directors who remain invested in the new or reorganized company provide a signal. Their confidence and incentives to improve performance can indicate that the changes will create real value. Greenblatt encourages investors to focus not only on the numbers, but also on the motivations and actions of those running the business. Historical examples show that investors who understand mergers and restructurings can earn substantial returns. Companies that successfully integrate acquisitions or reorganize their operations often see significant stock appreciation over time. Those who ignore these opportunities, or who fear the complexity, miss out. The lesson is clear. Confusion and complexity in mergers and restructurings are not barriers, they are opportunities. Finally, Greenblatt advises patience and careful analysis. Every merger or restructuring carries risk, and not every deal succeeds. Investors must separate noise from reality, assess management competence, and estimate the probability of success. By doing so, they can find investments where the odds are heavily in their favor. The next chapter continues this journey into overlooked areas of the market with rights offerings. Here, companies offer existing shareholders the chance to buy additional shares, often at a discount. Like spin-offs and mergers, rights offerings create temporary market inefficiencies that smart investors can exploit for profit. Chapter 3. Rights offerings. Rights offerings occur when a company gives its existing shareholders the opportunity to purchase additional shares at a discounted price before the general public. This is usually done to raise capital for growth, acquisitions, or debt repayment. On the surface, it may seem like a routine financial move. However, Joel Greenblatt highlights that rights offerings often create hidden opportunities for investors who understand how they work. When a company announces a rights offering, many investors react emotionally. They worry about dilution, assuming that their existing shares will lose value because more stock is being issued. Institutions and mutual funds may also sell their shares to avoid holding the new ones, especially if they have restrictions on buying certain types of stock. This fear-driven selling can push the stock price down temporarily, even when the company's fundamentals are strong. The key insight Greenblatt offers is that the discounted price provided in a rights offering often underestimates the real value of the company. If an investor buys the new shares and understands the total value of the company, the upside can be substantial. The market's short-term fear creates an opportunity for long-term gain. This is a situation where logic and patience can outperform emotion and herd mentality. Greenblatt explains that analyzing rights offerings requires careful research. Investors should assess the reason for the offering. Is the company raising funds for profitable expansion or simply covering losses? Understanding management's motives and the company's financial health is critical. A rights offering from a healthy company can be a signal of opportunity, whereas one from a struggling company may carry more risk. Another factor to watch is market reaction. When large shareholders or institutions sell shares during the offering, the price may drop further, increasing potential gains for disciplined investors. Greenblatt emphasizes that timing is important. Investors must be ready to act when the market misprices the stock, but also patient enough to wait for the company to realize its value over time. One of the advantages of rights offerings is that they often come with favorable terms for existing shareholders. The discount allows investors to buy below market value, creating a built-in margin of safety. This aligns with Greenblatt's philosophy of reducing risk while maximizing potential rewards. By focusing on these inefficiencies, ordinary investors can outperform larger market players who avoid complex or less liquid situations. Rights offerings also demonstrate a broader principle. Many opportunities in the stock market exist, not because companies are doing extraordinary things, but because investors fail to think independently. Fear, rules, and short-term thinking often lead to mispricing. Greenblatt encourages readers to embrace complexity rather than avoid it, as this is where hidden profits are found. Finally, Greenblatt advises combining knowledge with patience. The benefits of a rights offering are rarely immediate. The market may take weeks or months to recognize the value of the new shares. Investors who understand the story, manage risk, and stay patient are often rewarded handsomely. Having explored rights offerings, Greenblatt sets the stage for the next chapter: risk arbitrage and merger securities. This chapter delves deeper into situations where mispricing occurs during corporate deals, providing yet another avenue for disciplined investors to gain above-average returns while others remain fearful or confused. Chapter 4. Risk arbitrage and merger securities. Risk arbitrage, also called merger arbitrage, is a strategy that focuses on corporate deals where one company is acquiring another. Joel Greenblatt explains that these situations often create temporary mispricing in the market, which smart investors can exploit. While the term sounds complex, the basic principle is simple. When a deal is announced, the target company's stock usually trades below the acquisition price because of uncertainty. The gap between the current price and the expected payout is where opportunity lies. When an acquisition is announced, many investors react emotionally. Some fear the deal might fail, others panic at price fluctuations, and large institutions often avoid buying due to internal rules or risk limits. This selling pressure can push the stock price below the actual expected value, creating a chance for patient, well-informed investors. Greenblatt emphasizes that understanding the deal's details is critical. The better you understand the likelihood of the merger succeeding, the more accurately you can estimate potential profits. Risk arbitrage is not gambling. It requires careful analysis. Investors must evaluate the terms of the deal, the financial health of both companies, regulatory risks, and market sentiment. Greenblatt teaches that disciplined investors can calculate a reasonable estimate of risk versus reward. For example, if a company announces that it will be bought at a fixed price in cash, the investor can estimate the probability of completion and decide whether the current stock price provides a sufficient margin of safety. Merger securities include not only the stock of the target company, but also other related instruments, such as bonds or options issued during the transaction. These securities can also be mispriced temporarily because the market is focused on short-term noise rather than underlying value. Investors who understand the mechanics of the deal and the incentives of management can identify opportunities where risk is limited and potential gain is significant. Greenblatt stresses the importance of timing. Risk arbitrage works best when investors act quickly after a deal is announced but remain patient until it is completed. Deals can take months to finalize, and the stock price may fluctuate during this period. A calm, analytical approach allows investors to profit while others react emotionally. Another lesson from this chapter is that markets often overestimate risk. Investors frequently assume that deals are more likely to fail than they actually are. By analyzing historical trends, regulatory hurdles, and the motivations of both companies, an investor can gain an edge. Risk arbitrage is not about avoiding risk entirely, but about understanding it better than most participants. Greenblatt provides numerous examples where disciplined arbitrage strategies generated returns far above market averages. In every case, the investors who succeeded were those who studied the deal, understood the incentives, and stayed patient while others panicked. This chapter connects naturally to the next topic: recapitalizations. Like mergers and risk arbitrage, recapitalizations involve structural changes within a company that create temporary inefficiencies in the market. By learning to recognize the signals behind these changes, investors can continue to find undervalued opportunities while avoiding the mistakes of the crowd. Chapter 5. Recapitalizations. Recapitalizations occur when a company changes its capital structure, often by altering the mix of debt and equity. Joel Greenblatt explains that these corporate events are not random. They are usually designed to improve financial efficiency, fund growth, or create shareholder value. While the changes may seem technical or confusing to many investors, they often create opportunities for those willing to look deeper. A common form of recapitalization is when a company issues debt to buy back stock. This can increase the value of remaining shares by reducing the number of shares outstanding and by taking advantage of favorable interest rates. Another approach is when a company issues new equity to pay down debt or fund expansion. These actions temporarily unsettle the market because investors react to the structural change rather than the company's underlying business. Greenblatt emphasizes that the key to profiting from recapitalizations is recognizing mispricing caused by misunderstanding or fear. Many investors fear dilution or worry that added debt increases risk. Large institutions may avoid the stock because of rules limiting exposure to leveraged companies. This creates a temporary gap between the stock's market price and its true value. Patient, analytical investors can take advantage of this inefficiency. Understanding management incentives is essential. Companies that recapitalize often provide signals about confidence in their business. For example, when management uses debt to repurchase stock, it indicates belief that the shares are undervalued. Investors who study these actions carefully can separate meaningful moves from routine financial adjustments. Greenblatt stresses that reading the company's filings, press releases, and financial statements is critical to understanding the strategy behind a recapitalization. Recapitalizations also often reveal hidden value. A company may restructure its balance sheet to reduce costs, improve efficiency, or prepare for expansion. Once the market recognizes these improvements, the stock price often rises sharply. Investors who identify the opportunity early can profit significantly before the broader market catches on. Another important point Greenblatt makes is that timing and patience are vital. The effects of a recapitalization may take months to materialize. Early investors must resist panic during short-term volatility. They must also recognize that not all recapitalizations create value. The key is thorough research and understanding whether the change aligns with long-term business strength. Historical examples demonstrate that investors who studied recapitalizations carefully were often rewarded with returns far exceeding the market average. These situations are prime examples of how temporary confusion or fear can create profitable opportunities for disciplined and informed investors. Recapitalizations are part of a broader theme in this book. The market often misprices companies during periods of change. By recognizing the patterns of human behavior, fear, rules, and short-term thinking, investors can gain an edge. Each of these situations, whether spin-offs, mergers, or recapitalizations, shares a common characteristic. They create temporary inefficiencies that smart investors can exploit. The next chapter builds on this understanding by exploring bankruptcies. In bankruptcies, the market often overreacts to fear, selling assets at steep discounts. Greenblatt shows that these distressed situations, when carefully analyzed, can provide extraordinary investment opportunities. Patience, research, and understanding human behavior remain the key to success. Chapter 6. Bankruptcies. Bankruptcies are often seen as the most frightening situations for investors. When a company declares bankruptcy, many people assume its stock and bonds are worthless. Joel Greenblatt, however, teaches that this is a misconception. While bankruptcy signals trouble, it also creates opportunities for those who understand the process and can analyze the underlying value. A bankruptcy occurs when a company cannot meet its financial obligations and seeks legal protection to reorganize its debts. There are different types of bankruptcy, but the one most relevant to investors is reorganization bankruptcy. In this scenario, a company works with creditors and the court system to restructure its operations and debt. If successful, the company can emerge stronger and more efficient, sometimes creating significant gains for patient investors. The key insight Greenblatt shares is that the market often overreacts to fear. When a company announces bankruptcy, most investors sell immediately, pushing the stock or bonds down far below their eventual recovery value. This panic-driven mispricing is where opportunities arise. For those willing to do careful research, a bankrupt company can become a source of above-average returns. Analyzing bankruptcies requires understanding the hierarchy of claims. Creditors are paid first, followed by bondholders, preferred shareholders, and finally common shareholders. Greenblatt emphasizes that the risk and potential reward vary depending on where you invest. Common stock is the riskiest, but can offer the largest upside if the company successfully emerges from bankruptcy. Bonds are usually safer, but may offer more modest returns. Another important factor is management and operational quality. Not all bankrupt companies recover. Success depends on the ability of management to execute a reorganization plan, the viability of the business model, and the market environment. Greenblatt stresses that investors must study court filings, restructuring plans, and financial statements to make informed decisions. patience and careful judgment are critical. Bankruptcies also provide opportunities for arbitrage. Distressed securities often trade at steep discounts, creating potential profits when the company completes its reorganization. Greenblatt points out that some of the best investment returns in history came from investing in companies that were in financial distress but had strong underlying businesses. These situations require a combination of courage, research, and discipline. He warns, however, that bankruptcy investing is not for everyone. It involves risk and can be emotionally challenging. Many investors avoid these situations, which is why mispricing exists. The principle remains the same. Temporary confusion and fear create opportunities for informed and patient investors. Greenblatt concludes the chapter by connecting bankruptcies to other special situations. Like spin-offs, mergers, and recapitalizations, bankruptcies create temporary inefficiencies in the market. Investors who recognize these patterns can profit by thinking independently, analyzing carefully, and acting decisively. The next chapter, Restructurings, Liquidations, and Stub Stocks, expands on this idea. It shows how companies in transition, even when they are downsizing or partially liquidating, can present unique opportunities. Understanding these situations continues to build the foundation for finding undervalued investments that the broader market ignores. Chapter 7. Restructurings, Liquidations, and Stub Stocks. Restructurings, liquidations, and stub stocks are among the most overlooked areas of the stock market. Joel Greenblatt explains that these situations often frighten ordinary investors because they involve companies undergoing dramatic changes. But within that fear lies opportunity. These events create temporary inefficiencies that patient and informed investors can exploit to achieve above-average returns. Restructurings occur when a company reorganizes its operations, finances, or management to improve performance. This can involve selling divisions, cutting costs, refinancing debt, or changing management incentives. Similar to recapitalizations, these changes often confuse the market. Many investors react emotionally, fearing that the company is in trouble, while large institutions may avoid the stock due to internal restrictions or policies. This mispricing creates opportunities for investors who are willing to dig deeper and understand the reasons behind the restructuring. Liquidations, on the other hand, involve companies selling off assets, often during bankruptcy or severe financial distress. While liquidations may seem bleak, they can offer hidden value. Often, the market underestimates the worth of the individual assets, selling them at a discount. Greenblatt emphasizes that by analyzing balance sheets, asset valuations, and management intentions, investors can identify cases where the total value of the company's parts exceeds the market price of its stock. This approach allows investors to profit even when the company itself is struggling. Stub stocks are the remaining shares of a company after a spin-off, merger, or restructuring. These stocks are often overlooked because they represent only a portion of a business that may seem insignificant. However, Greenblatt points out that stub stocks can be extremely profitable. They frequently trade at a discount because investors focus on the larger, more visible parts of the company, or are confused by the corporate changes. By studying the financials and understanding what remains in the stub, investors can uncover undervalued opportunities. A recurring theme in these situations is market overreaction. Investors often make decisions based on fear, emotion, or short-term thinking, rather than analyzing the underlying fundamentals. Large institutions are slow to react or constrained by rules, creating temporary mispricing. This is the essence of special situations investing, finding opportunities where the market's emotional response creates a gap between price and value. Greenblatt also emphasizes the importance of research and understanding incentives. For restructurings and liquidations, examining management actions, debt structure, and asset value is essential. For stub stocks, the key is to determine whether what remains is undervalued relative to the market's perception. In every case, patience is required, as the market may take time to recognize the true value. These opportunities are not obvious and require effort to uncover. Most investors avoid them because they are complex or appear risky. But Greenblatt reminds readers that extraordinary returns often come from looking where others are not looking. The discomfort that scares the majority creates profits for disciplined and informed investors. Having explored all the major types of special situations in Part 1, Greenblatt prepares readers for Part 2. The focus now shifts from where to look to how and when to invest. Understanding the mechanics of these opportunities is not enough. Investors must also learn to analyze risk, practice patience, and apply a systematic approach to turn knowledge into profitable action. The next chapter begins Part 2 with the magic of Joel's investment approach, showing how to combine these insights into a coherent strategy that consistently outperforms the market. Part 2. How and when to invest. Part 1 showed you where to look for stock market profits. You now understand that spin-offs, mergers, rights offerings, recapitalizations, bankruptcies, restructurings, liquidations, and stub stocks create temporary mispricing in the market. These are the places where ordinary investors can find opportunities that most professionals ignore. But knowing where the opportunities exist is only half the battle. Part 2 focuses on how and when to invest in these situations, turning insight into profit. Joel Greenblatt emphasizes that investing is not just about spotting undervalued situations. It is also about having a disciplined approach, managing risk, and exercising patience. Many investors fail not because they cannot find opportunities, but because they act impulsively, ignore fundamentals, or overreact to short-term price movements. Part 2 teaches how to combine knowledge, judgment, and timing to consistently make smart decisions. At the heart of this part is Greenblatt's investment philosophy, which blends careful research, logic, and behavioral understanding. He explains that while opportunities are everywhere, success depends on analyzing each situation carefully, avoiding emotional reactions, and using a structured approach to assess potential reward versus risk. This approach transforms what might seem like chaotic market events into logical, high-probability investments. Risk management is a central theme. Even the best opportunities carry uncertainty. Greenblatt shows how to protect your capital through careful analysis, using the concept of margin of safety, and avoiding overexposure to any single situation. The goal is to maximize profit while minimizing the likelihood of permanent loss. Patience is another key principle. Many of the special situations from Part 1 take time to realize their true value. Prices do not always adjust immediately, and short-term volatility can be intimidating. Greenblatt teaches investors to remain focused on fundamentals, avoid panic, and allow their analysis to play out over weeks or months. Part 2 also connects the lessons from Part 1 into a practical framework. You will learn how to evaluate opportunities, prioritize investments, and decide when to act and when to wait. By combining research, risk assessment, and patience, you can approach investing in a way that consistently takes advantage of the market's inefficiencies. Finally, Part 2 sets the stage for actionable strategies. The next chapter, The Magic of Joel's Investment Approach, reveals how Greenblatt applies these principles to identify the most profitable opportunities in a logical and repeatable way. You will see how all the knowledge from Part 1 comes together with a disciplined approach to make ordinary investors capable of extraordinary results. Chapter 8. The Magic of Joel's Investment Approach. Joel Greenblatt calls his investment approach magic, not because it is mysterious, but because it is simple, logical, and repeatable. He emphasizes that most people overcomplicate investing. They chase hot tips, follow trends, or react emotionally to market swings. Greenblatt's method, by contrast, is based on disciplined research, careful analysis, and understanding special situations. The magic comes from combining knowledge with patience and judgment to exploit inefficiencies that most investors overlook. The first key element of his approach is finding mispriced opportunities. As seen in Part 1, events like spin-offs, mergers, recapitalizations, and bankruptcies create temporary confusion in the market. Greenblatt explains that the market often misprices these securities because most investors are unwilling or unable to do the detailed work required to understand them. By focusing on these overlooked situations, a disciplined investor can gain an edge. Next is analyzing fundamentals. Even in special situations, the underlying business must have real value. Greenblatt emphasizes examining financial statements, understanding management motives, and assessing the competitive position of the company. The goal is to separate emotion from reality, determining whether the market's fear or confusion has created a genuine opportunity. The investor who can do this consistently will outperform those who rely on luck or hearsay. Margin of safety is another central concept in Greenblatt's magic formula. This principle, borrowed from legendary investors like Benjamin Graham, involves ensuring that the stock is purchased at a price below its estimated intrinsic value. By maintaining a margin of safety, investors protect themselves against mistakes, unexpected events, or short-term volatility. Greenblatt stresses that a disciplined margin of safety is the difference between speculation and intelligent investing. Patience is essential to the approach. Many special situations take time to resolve, and short-term price fluctuations can be misleading. Greenblatt teaches that investors must wait calmly while the market recognizes the true value of the opportunity. Those who act impulsively or sell out of fear often miss the best gains. In essence, the magic comes from combining insight, discipline, and timing. Another important aspect is thinking independently. Greenblatt warns against following the crowd or reacting to market noise. Most investors act emotionally, creating mispricing. By maintaining an independent perspective, analyzing the facts, and trusting one's research, an investor can take advantage of the mistakes of others. This independent thinking is a hallmark of stock market geniuses. Greenblatt also highlights that his approach is repeatable and systematic. It is not about luck or one-time successes. By consistently applying the same principles, identifying mispriced situations, analyzing fundamentals, maintaining a margin of safety, exercising patience, and thinking independently, investors can generate consistent above-average returns over time. He provides examples where disciplined application of these rules turned ordinary investors into very successful ones. Finally, Greenblatt prepares the reader for the practical application of his method. Understanding the strategy is important, but the next steps involve research, timing, and risk management, which are explored in the following chapters. In the next chapter, The Importance of Research and Patience, he shows how diligent investigation and disciplined waiting are as vital as identifying opportunities themselves. Chapter 9. The Importance of Research and Patience. Joel Greenblatt emphasizes that even the best opportunities in the stock market are worthless without proper research and patience. Many investors fail, not because they cannot find opportunities, but because they act without understanding the details or give up too soon. In special situations, such as spin-offs, mergers, recapitalizations, and bankruptcies, success depends heavily on carefully studying the company and its context before making a move. Research begins with understanding the story behind the company. Greenblatt advises investors to read financial statements, SEC filings, press releases, and analyst reports. Every piece of information matters. For example, a spin-off might seem undervalued until you understand the parent company's motives and the new company's management incentives. A merger might appear risky until you examine the deal terms, regulatory environment, and past acquisition history of the companies involved. By combining these details, an investor can separate fact from rumor and emotion. Greenblatt also highlights the importance of knowing what not to invest in. Not every special situation creates value. Some companies may be fundamentally weak, poorly managed, or trapped in unprofitable industries. Research allows investors to avoid these pitfalls. The disciplined approach requires rejecting opportunities that do not meet strict criteria, even if they appear popular or tempting. This is a key difference between amateurs and stock market geniuses. Patience is equally critical. Special situations often take time to unfold. For example, a spin-off may take months before the market recognizes the new company's true value. Mergers can be delayed by regulatory review, negotiations, or unexpected obstacles. Recapitalizations may only show benefits after debt restructuring or cost-cutting plans take effect. Greenblatt warns that impatience can destroy returns. Investors who sell too early often miss the full upside, while those who wait calmly are rewarded as the market eventually corrects its mispricing. Greenblatt also emphasizes that research and patience work together. Research gives you confidence in the investment, while patience allows that investment thesis to play out. Without research, patience is blind. Without patience, research is wasted. Together, they form the backbone of a disciplined investment strategy. Another important lesson is focus on probabilities, not predictions. Investors often try to predict the market or the short-term performance of a stock. Greenblatt advises instead to focus on the odds of a special situation playing out as expected. By evaluating scenarios, assessing risk, and estimating the probability of success, investors can make logical decisions instead of gambling. This method reduces emotional mistakes and increases long-term success. Greenblatt also warns against being swayed by short-term price movements. Markets are noisy, and daily fluctuations rarely reflect the underlying value of a special situation. Investors who understand the logic behind the investment can remain calm while others panic. Over time, the market recognizes true value, rewarding those who stay disciplined. Finally, this chapter sets the stage for the next critical principle: risk management and the margin of safety. Once you know where to look and understand the importance of research and patience, you must also protect your capital. Understanding risk, preparing for the unexpected, and maintaining a margin of safety ensures that your investments survive even if some situations do not unfold as planned. Chapter 10: Risk Management and the Margin of Safety. Joel Greenblatt emphasizes that even the most promising investment can fail if risk is ignored. Understanding and managing risk is as important as identifying undervalued opportunities. In fact, risk management separates successful investors from those who lose money, even when they make good decisions in theory. The concept of margin of safety, borrowed from Benjamin Graham, is central to this principle. Margin of safety means buying a stock at a price significantly below its estimated intrinsic value. This gap protects the investor against errors in analysis, unexpected market events, or short-term volatility. Greenblatt explains that no matter how careful your research, there is always uncertainty in investing. A margin of safety provides a cushion that allows investors to survive mistakes while still profiting when the market eventually recognizes the stock's true value. Risk management goes beyond price. Greenblatt stresses evaluating the nature of the opportunity itself. For example, a spin-off may seem undervalued, but if the new company lacks competent management or a viable business model, the risk is high. Similarly, a merger might offer upside, but regulatory hurdles or integration challenges can threaten success. By carefully assessing both price and underlying fundamentals, investors can minimize potential losses. Diversification is another tool for managing risk. Greenblatt warns against putting all capital into a single opportunity, no matter how compelling. Even in special situations, unexpected events can derail a thesis. By spreading investments across multiple high-probability opportunities, an investor reduces the impact of any single failure. The key is balancing focus with diversification, enough to benefit from research, but broad enough to protect capital. Timing is also part of risk management. Greenblatt notes that rushing into an investment without fully understanding the situation or acting impulsively can increase exposure to loss. Conversely, waiting for clarity and evidence while monitoring the investment carefully can greatly reduce risk. Patience allows investors to act only when the probability of success is high, and the price provides sufficient margin of safety. Psychology plays a role as well. Many investors are tempted to follow the crowd or act emotionally during market turbulence. Greenblatt emphasizes that understanding human behavior, fear, greed, and herd mentality is part of managing risk. Investors who remain rational, disciplined, and independent are more likely to protect capital and achieve long-term success. Greenblatt also highlights that margin of safety is flexible. In some situations, a smaller discount to intrinsic value may be acceptable if the probability of success is very high. In other cases, a larger gap is necessary to account for uncertainty or complexity. The combination of research, judgment, and patience determines the proper margin of safety for each investment. Ultimately, risk management is not about avoiding all losses. Losses are inevitable, even for the best investors. What matters is minimizing permanent capital loss and positioning oneself to benefit from opportunities where the odds are favorable. By combining a margin of safety, careful analysis, diversification, and disciplined patience, investors can survive setbacks and capture exceptional returns over time. The next chapter, Putting It All Together, builds on this principle. Greenblatt shows how to integrate knowledge of special situations, research, patience, and risk management into a systematic approach that turns ordinary investors into consistent, successful market participants. This is the final step in transforming insight into action. Chapter 11. Putting It All Together. In this chapter, Joel Greenblatt brings together all the lessons from Part 1 and Part 2 into a cohesive strategy for becoming a successful investor. He emphasizes that knowing where to look, understanding special situations, conducting thorough research, exercising patience, and managing risk are all essential. However, the real power comes from combining these elements into a systematic approach that can be applied consistently. Greenblatt begins by reminding investors of the opportunities discussed in Part 1. Spin-offs, mergers, rights offerings, recapitalizations, bankruptcies, restructurings, liquidations, and stub stocks are not random events. They are predictable situations that create temporary inefficiencies in the market. By focusing on these special situations, investors can find mispriced securities where the odds are in their favor. These opportunities are often ignored by the majority of market participants due to complexity, fear, or rules-based constraints. The next step is research. Greenblatt emphasizes that every opportunity requires understanding the company's fundamentals, management incentives, and financial structure. He advises analyzing filings, press releases, and historical performance to separate fact from emotion. Research allows investors to identify whether the situation presents a genuine opportunity or a hidden risk. Without this diligence, even the most promising situations can lead to losses. Patience plays a critical role in the strategy. Many of the special situations discussed take weeks or months to realize their full value. Markets are slow to correct mispricings, and short-term fluctuations can tempt investors to sell prematurely. Greenblatt stresses that staying disciplined and trusting the analysis is often the difference between average returns and exceptional profits. Patience is what allows an investor to benefit from the market's eventual recognition of true value. Risk management and the margin of safety remain central. Greenblatt reminds readers that no strategy is foolproof. Even well-researched investments carry uncertainty. By ensuring that every purchase has a margin of safety, diversifying across multiple situations, and carefully sizing positions, investors protect their capital and reduce the likelihood of permanent losses. This combination of research, patience, and protection creates a framework for consistent success. Greenblatt also highlights the importance of independent thinking. The market is full of noise, rumors, and herd behavior. Successful investors do not follow the crowd. They rely on logic, research, and careful analysis. By thinking independently and acting rationally, they exploit the mistakes and overreactions of others. Special situations provide a perfect environment for this, as the majority often misprices securities due to emotion or rules. Finally, Greenblatt illustrates how all the pieces fit together with practical examples. He shows how a disciplined investor can identify a spin-off, analyze the management incentives, ensure a margin of safety, wait patiently, and ultimately profit when the market corrects the temporary mispricing. The same process applies to mergers, rights offerings, recapitalizations, bankruptcies, and other special situations. The strategy is not about luck. It is about a repeatable, logical approach to investing. This chapter serves as a bridge to the conclusion, where Greenblatt encourages readers to realize that the potential to become a stock market genius exists within everyone. By mastering the principles of special situations, research, patience, risk management, and independent thinking, any disciplined investor can achieve above-average returns over time. The next section, Conclusion: The Stock Market Genius in You, wraps up these lessons and provides motivation for readers to apply them confidently in the real world. Conclusion: The Stock Market Genius in You. Joel Greenblatt concludes the book by reminding readers that becoming a successful investor is not about luck, fancy tricks, or insider knowledge. The potential to be a stock market genius exists within anyone who is willing to think independently, study diligently, and act patiently. The lessons in the book are not just theoretical. They are practical tools for finding opportunities where others see confusion, fear, or risk. Greenblatt emphasizes that the market is not perfectly efficient. Prices often fluctuate based on emotion, rules, or institutional constraints rather than true value. Spin-offs, mergers, rights offerings, recapitalizations, bankruptcies, restructurings, liquidations, and stub stocks create temporary inefficiencies. These inefficiencies are not random. They are predictable, repeatable, and exploitable for those who understand the underlying business and the behavior of other investors. The essence of being a stock market genius, according to Greenblatt, is combining several key principles into a systematic approach. First, you must know where to look. Part 1 of the book showed that special situations create opportunities that are often ignored by the broader market. Second, you must do your research. Understanding the fundamentals, management incentives, and financial structure allows you to separate fact from emotion and identify genuine value. Third, you must exercise patience. The market rarely recognizes the true value of a special situation immediately. It may take weeks, months, or even longer for prices to adjust. Impatience is the enemy of profit. Disciplined investors who wait for the market to reflect intrinsic value are often rewarded handsomely. Fourth, you must manage risk and maintain a margin of safety. No investment is without risk, but protecting your capital through careful analysis, position sizing, and diversification ensures that setbacks do not become disasters. Fifth, Greenblatt stresses independent thinking. Most investors make decisions based on fear, greed, or what others are doing. Stock market geniuses think differently. They evaluate the facts, trust their analysis, and act logically rather than emotionally. This independence is what allows them to profit from the mistakes of the crowd. Greenblatt also encourages readers to understand that the principles in the book are repeatable and scalable. You do not need to predict the market or rely on luck. By consistently applying the same approach, identifying special situations, conducting research, exercising patience, and managing risk, you can generate returns that outperform the average investor over time. The method is simple in concept, but powerful in practice. Finally, Greenblatt inspires readers to take action. Knowledge alone is not enough. It must be applied. The stock market is full of opportunities for those who are disciplined, informed, and patient. Ordinary investors, by following these principles, can achieve extraordinary results. The genius lies not in being smarter than everyone else, but in applying logic, research, and patience where others do not. The concluding message is clear. The potential to become a stock market genius is inside you. The tools, strategies, and insights are provided. It is up to the reader to apply them consistently. By combining awareness of special situations with disciplined research, patience, and risk management, anyone can transform confusion and fear in the market into consistent profit and long-term success. The appendix, case studies and investment examples follows, where Greenblatt provides real-world illustrations of these principles in action. These examples show how disciplined investors applied the strategies, overcame challenges, and captured significant returns, reinforcing that the methods in the book work in practice, not just theory. Appendix: Case studies and investment examples. In the appendix, Joel Greenblatt provides real-world examples of investors applying the principles discussed throughout the book. These case studies illustrate how ordinary investors, by following a disciplined approach, can achieve extraordinary returns through special situations like spin-offs, mergers, rights offerings, recapitalizations, bankruptcies, restructurings, and stub stocks. One case involves a spin-off where a large conglomerate separated one of its divisions into an independent company. Many investors ignored the new entity, assuming it would struggle without the parent company's support. Greenblatt's analysis, however, showed that the spin-off had strong management, a profitable business model, and solid growth prospects. By carefully studying financials and understanding the market's mispricing, an investor could purchase shares at a discount and realize significant gains when the market eventually recognized the company's true value. Another example focuses on mergers and risk arbitrage. A company announced it would be acquired at a fixed price in cash. The stock of the target traded below the acquisition price because investors feared regulatory hurdles and deal failure. A disciplined approach involved analyzing the probability of completion, understanding the deal's terms, and calculating expected returns. Investors who followed Greenblatt's method were able to profit as the market corrected itself when the merger was successfully completed. Rights offerings also feature in the case studies. One company offered existing shareholders the chance to buy additional stock at a discount to raise capital for expansion. Many shareholders sold their rights out of fear of dilution, driving the price down temporarily. By researching the company's fundamentals and recognizing the built-in value of the discounted shares, an investor could purchase them at an advantageous price and benefit when the market corrected. Greenblatt provides examples of recapitalizations where companies issue debt to repurchase stock or restructure operations. In several cases, the market initially reacted negatively, fearing increased leverage or uncertainty. However, careful analysis revealed that the companies were improving efficiency and creating value for shareholders. Investors who acted patiently, with a margin of safety, profited when the stock price reflected the underlying improvement. Bankruptcies and liquidations are highlighted as areas where fear often overwhelms rational analysis. Greenblatt shows how investors studied court filings, asset valuations, and management plans to find undervalued opportunities. By understanding the hierarchy of claims and the potential for the company to emerge stronger, investors captured substantial returns while the broader market avoided these risky-looking situations. Finally, the appendix includes examples of stub stocks, which often arise from mergers or spin-offs. The market frequently misprices these remaining pieces of a company because they are small or confusing. By analyzing what remained in the stub, understanding the business fundamentals, and exercising patience, investors discovered opportunities to profit from stocks that most others overlooked. Across all these examples, the consistent themes are clear. Careful research, understanding incentives, thinking independently, maintaining a margin of safety, and exercising patience. Greenblatt demonstrates that these principles are not theoretical. They are practical and actionable. They turn temporary market confusion, fear, and inefficiency into real profit for disciplined investors. The appendix reinforces the book's central message. The stock market rewards those who study, plan, and act logically, while most others react emotionally. By applying the strategies outlined in this book, ordinary investors can achieve extraordinary results and become true stock market geniuses.